Markets clearly didn't like the swap from Biden to Harris and a potential candidate. What does it mean for the future and why my macroeconomic model is getting bearish or neutral bearish right now, what it means for the future and how will that affect overall game plan and the markets from here? If you want to know, today is an important edition of the video. Please stay tuned. Alright guys, my name is Russ and today a Friday video, quite important, straight after Federal Reserve fund rate has been remained unchanged at 5.5 and we are still pricing 2 cuts in the coming months until the year end. On the other side, if we're gonna look right now, as I promised in my macro model, you can clearly see how that has changed. This is the first time since I've been sharing my model that we are actually in the bear trend here. Yes, we are still on the medium term. Drivers are neutral. Midterm, we are not yet bearish. But overall, the risk is building. And please notice the difference in the markets. For everyone who is just watching the charts, you remember how we've been before. We've been doing those 0.3, 0.4 longer up days pretty much every day. And now what we see, NVIDIA is 6% down, 10% up, 6% down. I've been telling you in the past that this volatility, especially on S&P 500 and NASDAQ, which are multi-trillion-dollar asset classes, it is showing us the risk here. This volatility is showcasing the potential threat for the markets. And moreover, what I've been indicating are the jobless claims. The jobless claims are not spiking just yet, but they're starting to move up to the new recent highs. As you can see here on the initial jobless claim list, we are still within the forecasted values, but there is a particular trend for that number to move up. And if you watch my videos, you understand that the jobless claims is not something that shake the market very rapidly, but this is something the most important for me that I'm actually going to watch. And I also pointed out that on Wednesday update, I wanted Jerome Powell to be much more clear, calling for a sequence of cuts, and he did not, which made me say that higher jobless claims caused risk to the market. Plus, I pointed that after Fed Day, we moved back into the downtrend. And we have the reason why Powell maybe didn't give us what we needed or wanted. This is this politics and election year that is quite complicated, but that may be the reason why he is going to slow-mo rate cuts. And slow motion rate cuts with jobless claims moving up is a huge market risk. And I think jobless claims are at the risk to spike here. Now, let's look at the S&P 500 chart. This 540 level that I just marked in yellow dash line is the level that you need to watch. Below is risk, above is bullish. And key medium term level for us is exactly here. And you see at a pre-open, we actually have spiked down. So technicals, action, and fundamentals are all in motion before our eyes. And I think in unison are pointing lower. And I actually expected yesterday 540 to slice break, and that's where we are at the moment of the recording of this video of Friday pre-market open. And I think if it's actually closes today below 540 into the weekend, that certain selling can appear. And moreover, also, as you remember, I have the certain column that is called seasonality. So normally August has a weaker seasonality. September is much worse months overall. So if we are not closing August above those values, that I would expect actually the negative September to kick in. And overall, I was bullish for 2024 for the entire year. And now, respecting my model, respecting all the KPIs, parameters I start to assess, I am leaning neutral, and maybe with the actually jobless claims spiking up, I would be fitting to be bearish. We still need to observe the jobless claims, of course, very carefully. And NFP, non-farm payroll, is going to report in just in a matter of an hour from here, or maybe by the time you're going to watch the video, those numbers will already be announced. So based on jobless claims, I see NFP actually flat to last month versus the street expecting it to be down. You can see that the Wall Street is expecting 176,000 while the previous value was at 206. So we are expecting the 30,000 drop in non-farm employment change. And since S&P 500 is in a downtrend, I expect the market to take that negatively. So wages come out too, and it's been volatile. So that number, even though I don't think it is meaningful, could spook people away from the disinflation story. You see, this is the disinflation story that we have for now. And if those numbers start to raise, that totally can change the entire narrative on the market. Now, looking at NASDAQ itself, you can see how what I've been telling you, those days of volatility, those huge 3% candles up and down, that what shows the risk to me. And notice please here how we grabbed that liquidity here and we were not able to hold those value. And where do we have the gaps, the fair value gaps, all the way down to here at 430, some number that I've been indicating a while ago, actually in the month of May. I remember to have this sign here. So yeah, we can also correct down to 430 in tech. Am I really worried? I'm actually short on tech, as I've been indicating in the Telegram alert group. I went in a large short on Apple. Yesterday also Apple helped me to fill into more of my shorts and didn't hold the level. So we will continue holding tech shorts while expecting the certain liquidity spikes in the market that would be accommodated by commodity asset classes. And this is something I've been indicating pretty much as soon as I recorded my previous video. I published that here in a group for the Telegram alert subscribers, newsletter subscribers, and immediately we got a notification pretty much within the 15 minutes from there that US Treasury increased liquidity buyback total to 30 billion, basically double them from 15 billion. So as I said, I do not know from now exactly what would be the forms of this liquidity increase. Would it come through the yield curve control? Would it come from the Treasury side? Would it come from for example, Federal Reserve bailing out regional banks? This is a certain index that can help us understand that. Let's have a look on those for a sec. KRE, or Regional Banking ETF, has been consolidating here for a while. You remember last year we had some issues with the regional banks. So we had this huge drop, and then basically Federal Reserve would have to come up with an emergency measure, and that's why we had this like long consolidation range, and then we shoot up, and now we are again closing here, gapping down per market. So that's like one of the indicators I like to watch. I think, of course, especially in an election year, Federal Reserve would do whatever it needs, whatever it takes to not hear those stories like we heard last year with those bank collapses. What I'm meaning here is that this extra liquidity would find its way into the asset classes that have both industrial usage and the store of value potentiality, for example, as silver. And looking here on a relative chart of silver versus Bitcoin on the monthly, obviously those are long moves. We can see that we had this FBO, I call them false breakout or false breakdown. It doesn't matter in this case. And normally if we are not able to close there, then we tend to bounce and go try to break through those diagonal resistance zone. I'm fine here having diagonal resistances as soon as they are relative charts, so they're not really tradable, those charts. They meaning much more for me here, those diagonal resistances. So if we are able to consolidate here for another month or two, since we are dealing here with actually comparable asset classes sizes, we are speaking here of something between 1.5 trillion to $2 trillion. For sure, in my opinion, there can be a certain liquidity flows between those two asset classes. But what really makes me be quite happy about silver is, first of all, the gold chart itself. Let's have a look on the gold in a second and analyze that. And the second thing, what makes me happy, is the gold to silver relative chart, and we're going to look at that in a second. For gold, I provided very clear game plan yesterday in the alert group. By the way, it's free and it will be free for all the newsletter subscribers, so it's less than $1 a day. If you'd like to get all my notifications, please feel free to subscribe to the newsletter of Data Dash and then join the Telegram group. But long story short, I think we have bottomed here temporarily, and only the drop below 2350 will negate my forecast. And in this forecast, I'm saying worst case scenario, we go down to 24,000 just simply because we are a little bit overbought on the short-term time frame. So this 24,000 is exactly the border of that red rectangle here, and I would expect us to actually maybe slightly bounce to 2400 here and then continue our trend up. Banks are still quite short on gold, but despite all, I think we have an attempt here to continue higher as soon as we are holding, of course, those lows, and as soon as we do not start to break the market structure. Market structure break, something that my viewers are familiar with, is the thing to avoid. And if you remember, I think I've been quite accurate actually observing gold as an asset class. Since I joined Data Dash channel, I gave my lows here. We still, I think, respected those possible low in gold when I gave it at around 1,990. That's where the bottom formation actually took place. And from there onwards, we shoot up a very significant move. Which is, as of now, roughly around 23% within just a few months. And now looking at gold to silver chart, I think also everything stayed in place here. My forecast when I drew those lines a few weeks back, 85.5, we're still not able to close above that. And as you remember, the fundamental ratio for gold to silver is towards 40. It should not be in 90s for a long period of time. And just in my opinion, we were retesting that line, which actually served us multiple times before as support and resistance. So it's fine to revisit it. Now looking at silver chart itself, I would say that my forecast for silver, if you look in the Telegram group, maybe it's going to be a little bit faster since we project the numbers this way. I think silver held 27.5 twice and now reached 29.3. So we can have a drop again because it's a little bit overbought on the shorter term time frames. 28.5, 28, it's all good. As soon as we don't lose 28, and then I am speaking of 40s. So looking now at the chart, as I said, I don't want to lose this yellow line, 27.8. Maybe we can even move it slightly high because I really love the reaction here. We would say 28. As soon as this like yellow line is held, I would expect us to continue higher from here. And don't forget what's the risk reward you're having here. If it's just $1 or $2 down, actually $1 down, we are speaking here about $40 for the troy ounce of silver. That's going to bring us another 42% up. And please don't forget how SILG and our miners would react to that. Once again, for those who don't remember, SILG is not my favorite ETF by far because it's too big companies included there, First Majestics and other, diluting their shares a lot. But still, it's a clear uptrend. It's a clear uptrend. Low, high, lower, higher low, apologize, high, higher low. I would expect to see something like that. And what gives me actually a positive outlook here is an understanding that on SILG to silver, we are just about to break through this a year plus consolidation. We entered that zone in May 2023, and for more than a year, we are in August 2024 right now, we could not break. And obviously there is a huge resistance here. It's not so easy. It's not going to happen like overnight, shoot up. Yes, we're going to have a little bit of distribution here, but I think this is probably an attempt to break through. Looking at some of our silver junior miners directly, I would like to project, for example, Kutney. Let's start with KTN. Not looking particularly great here, but obviously after yesterday's silver's correction, everything is okay for me. We are holding this range. This is going to be the upper side of the range. So yes, just to bounce back to the upper side of the range, we're talking about 40%. So you understand the degree of volatility here. I think something I would also like to project is GR silver mining. It looks much more bullish because we are already on the upper side of our range, trying to break out here. So we actually already did that 60% move from one part of the range to another. So yeah, for other players, I'm expecting a little bit of a consolidation and a breakout here rather than sooner than later. For others, once again, yes, we are on the lower side of the range. That's all good. And the reason why, for example, I don't want to be and those majors like First Majestic, because they clearly dilute their shares, and that's why they look much less prominent right now on this recent developers in silver that our junior miners, talking about 50 to $150 million market. Looking at equity metals, the same picture. It's very, very normal. It's very, very normal when you see those Elliott wave 1, 2, 3, 4, 5 move. You have your 5 waves up. Normally you have A, B, C correction down, right? This is very cool. For those who's not really familiar with the Elliott wave theory, of course, I'm gonna show more those things with the real examples. I always like to give some knowledge when it's applicable in a practical terms, like right now with the equity mining expansion. But yeah, you can also go in the Telegram group and let me know if it's actually something that you would like to learn more. We can actually have a specially dedicated video. This is not an easy thing because it's quite subjective, and it would take you at least a year or two until your Elliott wave assumptions would actually start making like much more sense, because the amount of potentialities of how you can project those waves is quite high. But coming now to the charts, Bitcoin gave us a very interesting trade yesterday that I just wanted to represent. So you remember here yesterday we've been selling off very aggressively. The price was going down. You can see both driven by cumulative volume delta on spot and futures. On the other side, the open interest, those shorts were piling in more and more. You can see it with the decline in the funding, and those shorts were really building up a lot towards every spike. And even when we start breaking the market structure, so market structure break starts already to manifest, and those shorts obviously have been left off guard, and that's what happened. A very quick price growth, more than 3.6% in a matter of an hour and a half. That was an amazing trade entry, but it's also for you important to understand this trade entry was not sustainable because it was not driven by the new long stepping in. It was driven by those shorts that have been building in a very aggressive, very unprotected manner. That was driven by them basically puking, closing, whatever the word you want to use. Obviously, they were left off guard and they were pretty much obliterated. And this is type of the market that you can, in my opinion, take always an advantage of when you see that one side of the market is a little bit exuberant, is very aggressive. It's basically jumping out of its pants, just trying to short whatever happens. And then market structure breaks comes in. And obviously, that's a clear sign for more rational market participants that, yeah, market structure breaks means you have to get out. So people start to get out, and then the ones that are left last are those ones that are losing. And so you can actually step on the longer side of the trade and make those trades. I was doing those trades yesterday, recently. I unfortunately could not be on Telegram. As you can see here, for example, I saw that XRP has a strength, so I entered here on the market structure break in the green line around 58 cents, and I sold at that particular bounce. When I start seeing that no new longs are coming, I just sold that top. And the best thing, but I actually like to do it on spot, especially on Bybit, is because first of all, the trading fees are zero, so you don't pay any fees when you're trading on USDC pair. And moreover, when you're setting up your limit, you're saying, for example, I would like to buy $100,000 worth of XRP, you can immediately attach take profit and stop loss to your order. So that's a huge game changer for me. I don't need to wait when my order is filled or not. I can actually come and catch some price, which is a little bit below here for now. I'd like, for example, XRP to swipe those low, and I would like to buy it, let's say, at 55 cents, not for market price, but at 55 cents. And I'd like to attach my stop order, for example, at 53 cents. Considering that, I would like to have a reversal here. So my maximum loss would be only 4,600, or of course, I can reduce the size of the trade and only trade, for example, $10,000, so that my maximum loss would be only 450 USDC, right? So this is something that other platforms do not provide. That's why if I ever going to do that type of spot trades, I think it's very significant to do it where all this functionality is enabled. And moreover, of course, you can always come and take profit or stop loss to already existing position, so you don't really need to set it in the beginning. But setting up in the beginning changes gives me a lot of relief. Exactly the same type of trade I've done in Ethereum yesterday is because my orders are quite huge. They split in multiple. Unfortunately, only shows last 100 orders on the chart. But just to confirm, you see my filled price. I start scaling around 3,100 and then scaled all the way to 3,117. Here, the filled price, Ethereum into USDC to avoid any fees. My trading fees are 0. That's 3,100. 3,117. That's the confirmation of this market structure break. This is my entries within that candle, and then I sold basically the swipe of those highs, the first sell and the second sell. I starting to sell when I saw that order block here we are about to lose. So yeah, those two were my sell signals. First is the oversold in a shorter term time frame, and second, the lows of the order block that give me an idea. Then from there onwards, we swipe those highs. We might come and swipe those highs too. So I wanted to go to bed. I didn't want to stay in the trade. All in all, guys, I think all of you can benefit from spot trading and especially avoiding the fees. I keep the link in the description to subscribe to Bybit. Bybit, if you allocate $100, is going to give you 500 USDT derivative trade. Of course, be careful on derivative. I trade very confidently on derivative, but that has been multiple years I've been doing that. Here, I would like to make a specially dedicated video for the next week where we're gonna go through my 3 favorite intraday trading strategies. Of course, one of them I already mentioned, Monday high, Monday low, but there are another 2 which are slightly more complicated and it will take more time to elaborate, so please stay tuned. For now, I'm looking at 63,000 to step more into the Bitcoin. I still think those 70,000 USDT highs and everything above has a huge amount of liquidity, so they're not safe. The highs are not safe, and the area around all-time high is not safe. But we also need to really see if the market are going to give us the bounce here or not. Even sometimes 1-2% of the bounce on Nasdaq is going to give us an opportunity for Bitcoin to pump this 5-6%, or maybe we would need to swipe Bitcoin one more time and maybe go to 60,000 and only then attack the all-time high liquidity around 71 later. With all that said, I'll try to be a little bit more prompt. I'm actually hiring people right now to support me on those intraday updates because it's very hard to manage multiple portfolios in crypto, in stocks, in options, in futures, and on top of that provide a real-time signal. So I definitely need help on that. With all that said, guys, I'd like to be a little bit more rapid next time. I'm entering those, for example, intraday trades like yesterday on Ethereum, yesterday on XRP were really good, nice trades because within 1 or 2 hours I pretty much made a nice monthly salary. But with all that said, I wish you an amazing end of the week. Touch the grass. Much love. And I see you soon. Bye.